Welcome back to another episode of Your Wealth and Beyond. The year is coming to an end. We've had a great season on the episode talking with a lot of entrepreneurs, learning about their journeys. Today, listeners, it's going to be more boots on the ground. We're going to talk fundamentals on how to be more efficient with your pre-tax dollars. And one of the number one concerns that successful business owners have is I am paying too much in taxes. So I want to welcome back to the show, partner of Bayntree Wealth Advisors, director of corporate development, and all things tax guru, Brian Hartstein. Welcome to the show. Was a mouthful there. Brian, you've got 30 years experience working with business owners and CPAs. What do we hear? What's the problem that a lot of these listeners that have actually built successful businesses, meaning they show profit, what are some of their biggest concerns that they have as the year is coming to an end?
Yeah, and now you're hitting the pain points, because although they're aware of, hey, we may have a pre-tax problem, I need to do planning, most won't address it until we get into the fourth quarter like we are now. We're coming to the end of the year. Got your numbers on the board, right? You can see how the year is going to shake out. So most business owners that are successful are saying, if the year is good and I'm going to generate X amount of revenue, I'm going to pay for everything I need to run my business, pay for my employees, pay for operations, and then take what I need to live my lifestyle. What does my family need from, cost of living? If I'm left with money in the business, what do I do? Because if it stays there or it flows to me, depending on your entity type, I'm going to get taxed and I'm going to lose the ability to use my pre-tax. And that's where their concerns come.
Yeah, we hear this all the time, the fire drill of this fourth quarter. It's like it would like them to plan throughout the year, but as you business owners are running and you've got, your employees, your clients, you've got marketing, all the things, it's not until this October, November, do we got to figure out what can be done. And if nothing can be done this year, we'll talk through on some things that you can look forward to in 2026.
Sure. Yep.
And something we talk about all the time is, when you have, whether you have 10 employees or 100 employees, who's one of the highest person on the payroll for these businesses?
It's Uncle Sam. Almost every time.
So we're going to, talk through today on some things, depending upon where you are in your journey as a business owner, some of the things that we've utilized for our clients, some of the things that are out there that you can start thinking about and go to your CPA and to think through on how you can be more efficient with some of these pre-tax dollars.
Right. And I think you hit the nail on the head when you're talking about looking at these things and being proactive, which is saying, hey, you have very specific things for your business, Mr. or Mrs. Business Owner. Let's look at the options. You probably have 3, 4, 5, 6 different planning options. Walk through them, try to find what fits you the best, but be proactive in your planning. Go out there and find them. There's a lot of great tools that you can utilize. We have our tools here that we use pretty well. And normally when we start trying to apply those tools, we've either spoken to a CPA or the client, and they either have a specific number in mind for the year, when they're getting down in November or December saying, hey, I have 5 figures, 6 figures of profit that I need to put away. By the way, I need to attract better talent. I need better employees. I need more employees to do the work. I need recruitment and retention tools. And maybe I can find a way to tie all these things together, right?
In working with business owners and CPAs and TPA firms for almost 30 years, what do you think the percentage of businesses that actually have some type of proactive retirement plan?
For a retirement plan, probably a considerable amount. Now, are they being proactive in making sure it's up to date, it's efficient, it's checking off the boxes and meeting those goals from a tax planning, a retirement planning, a recruitment, retention, all the things that they're going to want to do? So I look at it as like going to the doctor every year. If you're going to be proactive, you're going to probably go once a year, once every couple of years, just to make sure that you're, even what you set up was still on track. And so I'd say that's the smaller piece. If you said, if you're working with your tax practitioner, are they proactive? Are they reactive? I said they usually tend to be more reactive than proactive. So you've got to look to either your planning team or outside help to start finding the tools to bring those.
Yeah, and that's one of the things at Bayntree that we love doing is being proactive with a lot of our clients are successful business owners. They're on their journey. They're doing well in their business. But they, prior to coming to us, they didn't have a game plan. They were just looking in the rearview mirror. It's, what happened this year, right? And the CPA is not taken away from them. It's just that they're looking to help. How do we minimize as best we can? But they're not looking at what happened throughout the year. And that's where actually a lot of CPAs will come to us to see what kind of guidance, what kind of suggestions, what kind of recommendations can we do depending upon where we are in the year. And obviously, as we get closer to the end of the year, there's less that you can do, but there's a lot of things that can be done that a lot of you may not even know that you can do.
That's right. Or it can do them after the fact. So let's say your year is a calendar year. You operate with a 12/31 fiscal year end. There's things that you can do even in 26, which will help you in 25. So even when we get to the end of the year, game's not over, right? Now, do we lose maybe a planning opportunity or two? Yes. So always better to attack early, right? We love our fourth quarter tax planning meetings so we can be proactive before the year ends. But just because January 1 rolls around doesn't mean we stop, right? It means there's things that we can do backwards. And like you said, maybe we can't address all the problems because we hit them too late in the year, but then we're going to come out in the first quarter and we're going to make sure we'll do as much as we can backwards. And then we set the stage for what we want to do going forwards.
So you're telling me there's two things that we'll talk about today. One is helping the business owner, the high earner, save as much as they can on taxes. Because think about it, if you're running a successful business, you're probably at the 37% Fed tax bracket. Depending upon what state you're in, here in Arizona, it's 2.5%. But anything that you can be smart on, you're potentially saving upwards of 40 cents on the dollar.
Correct. And, some states are even higher depending on when you're located. So that's when we make that statement, hey, why is the government the highest paid employee? Because if they're on for 37% or 40%, you're probably paying them the most besides any of the other employees except for maybe the top, right?
And then you mentioned something earlier, which is so important in today's environment that we're in to try to, retain good talent, is to have a plan, if you have employees, that enables them to save for retirement and to keep them as a valuable asset of your team. So those are some things that we'll talk about today, depending upon, again, if some of our clients are solo entrepreneurs. Yeah, and there's a lot of fun things that you can do with the solo, which we'll go through. If you're just starting to get your business going, or maybe it's a side hustle, but you're like, all of a sudden, hey, Brian, I've got a couple $100,000 of profit from this side business. What can I do?
And there's a lot of things that you can.
And so you talk a lot about this pyramid.
Sure.
So let's break down to the viewers and the listeners, what is this retirement plan pyramid? What's it look like? And then we can go through it. We could probably spend 5 hours digging in today, but we're going to talk high level on each one.
Sure. So me, I can talk for more than 5 hours.
And believe me, audience, I will stop him. Him when he's
go to sleep early. But I grew up in the retirement plan industry, and I always visualize it in my head when you got your toolbox and you're working with a business owner, and we've got the CPA, we've got the attorney, and they've got their planning team. And we very much believe in that collaborative planning team. But when we've identified the problem, they said, I need to put $75,000 away this year, I'm going to get taxed on it, or $150 or $250. But I also need to do, just like we talked about, recruitment. We need retention. We need to find a way to attract talent. I want to reward myself. Maybe it's a family business. Maybe you want to reward family members. So you start working your way through what I call the retirement planning pyramid as potential tools to solve those problems. And some people are very familiar with pieces of this, and there's pieces which they've never heard of. And, we start at the bottom, which are called simple plans. Now, when the government calls something simple, do you think it's simple?
Never.
So that is kind of the very, very bottom of what we call a retirement plan pyramid. It's easy to put in. It's somewhat simple to run. You can only do a few things with it, but for some businesses, it's a great solution to be able to put that in, be able to put money away, have it not be taxed, and have the owners be able to save that retirement. As we work our way up, you run into SEPs, simplified employee pensions. Again, you can do a little bit more with them. There are some restrictions. If you have employees, not usually a great tool for a variety of reasons, although they're easy to set up for a business owner. So you talked about maybe those solo, entrepreneurs or people who are just getting started. Sometimes those two things are great, like kind of your starter.
Yeah, and the SEP IRA, a lot of the listeners may have one, right? And if they already have them, and again, the simplicity of it is that it potentially allows you to put up to about 25% of your net income away. But the challenge is if you do have employees, you have to do the exact same for them. And that's where a lot of employers and business owners don't really understand that. They may start their business and be like, okay, I'm going to do a SEP because the CPA told me to do it. It's super easy.
Right.
You don't have to bring a TPA involved. We could put, if we made 100,000, we may be able to put away 25,000. Again, keeping it simple. But now they've hired 2 more people and they didn't realize those employees, once they hit the qualifying term, which is usually 6 months to a year, they then qualify for that as well. And all of a sudden, if the owners put it away 25%, now their new employee that's making $50,000, guess what they got to do?
Right. And we run into that before. We've run into that situation, and sometimes we have to play backwards, where even a client made a contribution to a SEP, they realize they had employees, or they want to do more than the SEP allows, and we have to, in the next year, we kind of have to work backwards to solve the problem. But, normally the business owner is not thinking about the SEP when they're hiring somebody. So a lot of times what happens is they've had that SEP for several years. All of a sudden, it's been them, maybe and one other person. They pick up 4 employees, and then they start doing those contributions, and the CPA goes, you got a problem for this year in terms of that cost. And so that's usually where we get involved. So it's a great tool for the right fact pattern, but people grow out of it pretty fast.
And then we move up the pyramid, and this is one, if you're looking here, audience, it's the blue. The biggest, where most of you have had or have a 401k. And there's a lot of different ways on how 401k can be set up. But let's go through that just real basic and how the 401k works.
Right. And most people are probably the most familiar with this piece of the pyramid. It was kind of came about in the late 70s. By 81, the first 401ks as we knew it really kind of came into play. IRS approved that version of it. And by 83 or 84, probably half of the large companies in the United States were already offering the 401k. So, you're going back 40 years as a planning tool. Now, what's wonderful about the 401ks is it's really evolved. And what's good about Uncle Sam is they've been opening up legislation to make it more available to the American worker because they know people are going to need it. So the 401k is a wonderful recruitment tool, a retention tool. Most people who are working today are used to some type of 401k right in their environment. And it's a good tool for the owners of a business, highly compensated employees, to be able to save. But you do get capped at a certain level. So if people want to do some really high dollar savings, it may not be the only tool you might want to utilize to get there, right? Because you know what the caps are on 401ks, profit sharing.
Yep. And one of the things with the 401, if we have employees versus the SEP, and even the simple, is it's not as simple. Meaning we have to, a lot of times, bring in a TPA and walk through a lot of the listeners might have heard of TPA, but they don't know what is a TPA.
Sure. And I would say if you think of 401k, I always say break it into 2 pieces, design and structure. Design is what are all the specifics to a plan, right? What is eligibility? What is vesting? Everything that your company's built specifically for your plan. Structures who does what. The operational aspects, who's operating the plan. And that's where a third-party administrator comes in. Their job is to help set up the plan document. You're going to need a pension trust to govern the plan, put all the pieces in place, do the administration, file the tax returns, because most CPAs don't want to do that. So they're purely the administrators that handle that piece. And they're one of the structural pieces of a plan in terms of its operation. And you need them. They'll help you design the plan and they'll help you administer it. Right?
Yep. And so with the 401, you talked about these limits.
Sure.
And so most of individuals who've had a 401k, they know kind of what their limit is, but let's walk through what that means of what the employee can put in. And then we'll talk through a little bit on matching and safe harbor and what that looks like and how that can be used, again, as a retention tool, as a way to motivate the employees to start their own 401k and put away for their retirement.
Sure. So let's start with a couple different pieces. In a 401k, I always talk about A, B, and C. Real simple. A is what we call our salary deferral piece. And this works for business owners as well as the employees. So it covers everybody, right? So what's the salary deferral limit for this year for 2025 is
23,000.
Right? I think 23.5. Right?
23.5.
23.5. That means you can take all of that money out of your own pay, put it into either a traditional 401k or a Roth 401k if they offer a Roth. That's from your own pay. So that's somebody's own revenue they generate. That's A. Part B would be an employer match, right? So there's all kinds of different matches. You could have a safe harbor. You could have non-safe harbor. That has to go into the design of the plan. But that's how you reward an employee for being part of the company. It also let the owners put away sometimes as more to get up to those limits. But that's part B. So some companies have a match. Some companies don't have a match. Sometimes it's a safe harbor. Sometimes it's non-safe harbor. So that would be part B. And then part C is what we call profit sharing. So some 401ks have the profit sharing plan component, so where the company can actually put in more money above that $23,500 deferral limit. And by the way, if you're over age 50, you do get a catch up, right? In this year, they kind of made them more complicated as the government does, but you could put away, at least another, 11,000
up to 30,500. But then if you're over if you're 60 to 63 with the super catch up. So there's more rules that allows at certain ages to put away up to.
That's deferral. But the part C is profit sharing.
Yeah.
That's where the company can reward an employee or an owner for being part and eligible for that plan. And that'll get you up to about, let's say if you maxed out everything and you're under age 50, you're about at the 69, 70,000 level. If you're older, you might get up, in the high 70s, maybe even 8. And that would be your cap I talked about. That's about as much can go into those.
Yeah. And that's where a lot of analysis that we do for our clients, for the business owner, where they're looking at, okay, I want to put away as much as I can. Does the profit sharing make sense?
Right.
And that comes to really the diagnostics, running an analysis of how many employees you have, the ages of the employees,
Right.
Because there's certain things where they have set up with ERISA to ensure that the higher earners, usually the business owners, aren't doing things so that they can take advantage, but doing things to make sure that it's even across the board.
That's right. And so and business owners will come at it usually one of two ways. When we're working with a third-party administrator, and there's about 5 or 6 different formulas that you can use to come up with the allocation. So if you said, I'm going to put $1 into my profit sharing plan, who gets a piece of it? It's going to be, if I got 20 employees, how does that get allocated? So there's different formulas. And we usually get one of 2 instructions from the business owner. We'll say, I have $100,000 I'd like to put in the profit sharing plan this year. Put it in and just allocate it, across everybody's salary level, or everybody, if you make X, if you make 50,000 and our total payroll pool's 500,000, you get 10% of the contribution. But a lot of times they say, I'm going to put 100,000 in, use the formula that puts the most into the owner's pocket and the highly compensated pocket. And so there's ways to sometimes skew that so you can try to keep 50, 60, 70 cents of every dollar that goes in. And at the end of the year, we just try to find the formula that works best for the owners, right? And sometimes they're altruistic, but they also want to reward themselves to get to that maximum contribution level.
And that's whereas if you're running a successful business and you don't have a ton of employees, that's where the profit sharing can really make sense, where we've seen it sometimes up to 90+% of what's being put away is going into the owner's pocket.
That's right. And what's more important is sometimes that you just kind of hit on how you kind of find the tool as a business owner. So in your head, if you said, hey, this year, I don't really need to put away more than $50,000 or $70,000 of my pre-tax profit for myself, then you're probably in that 401k profit sharing plan space, right? If you said, I need to put away 100, 200, 300, or do some different things, maybe you're looking at a different style plan, right? If you're looking at less than 50, you probably could even use the SEP, to do that, or a simple IRA or a simple 401k to do that. So that trying to figure out what you want to put away also helps kind of guide you in the pyramid where you want to go.
Now, before we talk about the Cadillac plan, the cash balance plan, 401ks with potential profit sharing, we're already into almost November now. Can business owners put in place a 401k for this year?
Sure. And so you can put in generically, yes, you can do a 401k for this year. And if you wanted to still do salary deferral, if you could get it in through your payroll, you can get it right up this.
Because that has to be done by December 31st, right?
It does, usually because they're going to want to file your 941s in mid-January, and then you're done with salary deferral. But if we go into 2026, you could still put a profit sharing plan in and have it count backwards for 2025. So there are things that you might want to do today, although for safe harbor plans, we're really looking at kind of the deadline to get them in because we have to do some notification to the employees. So that's why I always say, if somebody misses the boat at the end of this year, let's not miss it again at the beginning of next year. Let's tack it earlier. But, there's plenty of planning opportunities even after this year closes. But if you want to get that salary deferral piece in on a 401k, you're going to want to do that before 12/31. After that, you can use profit sharing, and you can use defined benefit pension plans, and you can use all the other.
And then you talked about the matching. We won't get too much into the weeds, but in 2026, there's another rule changing for high earners.
That's right.
What's that look like for the business owner that may already have a plan and they haven't gone through this, or what this is going to look like?
Right. So for what they're saying is normally for making those catch-up contributions for those earners, if you're a high wage earner, they want those contributions and matches to be in Roths, right? They don't want you to make traditional 401k contributions that you can deduct. So and it's weird because they didn't match up the true highly compensated figure. It's at 145,000. That's been indexed past there, but it kind of stayed there. That's the cutoff. So if a plan offers a Roth option and you're over that wage limit, you're going to get those in, and you're going to get those in Roth contributions. So not necessarily the worst thing. You just don't get the tax deduction today. You'll get the tax-free income down the road. If a plan doesn't offer a Roth, then you won't be able to make that at all because you'll be coming out there. But most plans today
I was going to ask you, most of the plans you're seeing and we see, they have the Roth portion.
The Roth, and we push for that because we think it's a wonderful feature for Plan F. But there's plenty of plans in and around that we work on 20, 30 years old that still don't have a Roth feature. And there's good reasons for that. But, we're always big advocates.
And if an employee is doing the deferral and they're using all Roth, so let's just say somebody under 50, they're doing the $23,500 all in the Roth. And again, that is a situation based on for each individual. They have to look at how close am I to retirement? What's my tax situation going to look like? Maybe it's a combo where you do part of it in the pre-tax, part of it in the post-tax. But on the matching side, the regular 4%, let's say that most companies have, that is going to be done in a manner that's going to be pre-tax.
Correct. Most of the time, it's going to come in pre-tax. The company's going to want to deduct it as it costs, and you're going to get that as a pre-tax contribution. So even if somebody is contributing all to the Roth, they're still going to have that bucket. If they got a match, that's probably a pre-tax bucket, right?
Yep. And if you're not a business owner and you just real quick on that end, if you're working to have a 401k and they're doing a matching, if it's 3% or 4% or 5% or 6%, you got to put the money, do a
free money. I don't know.
Why would you not do it?
Afford it, which I understand. You're giving up free money. And I don't see free money too often. So I try to grab it with both hands.
Yeah. And people don't miss it. We're talking, even if it's 4%, yes, I know it's tough out there. Inflation, groceries are expensive. But if you do that, you're just setting the stage for the long-term success of being able to retire at some point, and you're getting free money along the way. So if you're not a business owner and you've got to make sure you're taking advantage of it.
A lot of plans come now where they do the automatic enrollment, right? So people are automatically enrolled less they waive out. That's a great way to get people in so that even if they're not focused on helping themselves, they're going to get help, right? And they're going to take it.
Are you seeing more plans offering that increase, that automatic too, of like 1% a year?
With trustees yesterday about they don't have automatic enrollment and they don't have the auto increase. So in this case, we're going to do auto increase up to their match limit. So in this case, you could go up to 10 and then it just kind of levels off. In this case, we'll do it up to 6 because that's what their match limit is at. So.
And when we're doing an analysis with a potential new client who already has a plan in place, 401k profit sharing, what are some of the issues that you see? Is it just like there's not a coordination of what is underneath the hood and nobody's talking to one another?
In terms of implementing the plan?
Implementing and then making sure the plan is as efficient as possible and, the lowest fees and things of that nature. Like what are some of the things that you see out there those top 2 or 3 things that a lot of times can be fixed if you've got the proper people and the proper team aligned?
Sure. And I would say, usually there's 3 pieces to the plan, depending on how it's structured. There's you could have one group doing them all, or you could have it, decompartmentalized. The third party administrator you spoke about, the record keeper, that's who's keeping track of money type, setting up the individual accounts, Vanguard, John Hancock, Principal, all those great companies. And then plan advisory support. Unless it's a sizable company that's got a good HR staff, they're going to need some type of plan advisory support at the trustee level, helping the owners and the trustees meet their fiduciary obligations. And then educational support, employee support. What are they doing to fulfill 404C of ERISA and make sure the employees have everything that they need to be able to, make the best decisions. But just like you said, who's looking at what's the grease between the wheels? Usually that's a group like an advisory firm like ours or another advisory firm that's not only can kind of coordinate all those pieces, but then each year would say, okay, let's look at design. Maybe there's things we should be doing that we're not doing that your business has changed. Maybe let's look at fees. Let's go out and benchmark the plans. Because for most small businesses, Andrew, the owners probably have at least a third to half of the retirement assets in the plan. So if you can say, hey, we're going to be able to save 25 basis points, we're going to be able to save 35 by finding inefficiencies in the plan, solving those and then bringing more services in. Well, if you have $1 million in your account over 10 years, that's real money you're saving, right? So that's where we see a lot of the business owners focused is not only just on how can I make my plan a better experience for the employees, but how can I make it more efficient so it helps me in the end, right?
And that education piece is something that we pride ourselves on here at Bayntree with the clients that we have, the business owners that have the 401ks, being able to have our advisors position out, some stuff that a lot of people may be like, oh, we know that, but so many people don't. And so putting out the not just coming in for coffee once a year, but doing these educational videos to help guide their employees. It's an extra, besides covering their bases.
Right.
It's a great value add.
Great value add. And people really need it. And a lot of companies are now getting more and more focused on doing that and using groups like ours to be able to drive that type of education to the employees. And it's been proven. You have a happier workforce, more productive workforce that are less concerned maybe about financial questions and personal questions, and then they are more productive for you.
Awesome. So Let's get to the top of this pyramid.
Top of the pyramid. So one of the great things about a 401k profit sharing plan for business owners comes down to cash flow. Because every business owner, even if you have 20 great years in a row, is convinced next year is going to be, that's the year we're going out of business, or that's the off year, right? So the good thing about a profit sharing plan 401k is you can turn those contributions up or down. So if you said 1 year, like on a profit sharing plan, I don't want to make any contributions, business wasn't good, yes, you go to zero, just like that, right? Now, you have a cap, you have a ceiling we talked about. So those are great for plans that maybe do have some variable cash flows that come in or they're unsure. When you get up to the next level, when you get to what we call cash balance plans, defined benefit pension plans, there's pros and cons. They give because they let you put a lot more money away to be able to fund benefits into retirement. So larger tax deductions, larger pools of money that you can save as an owner. Right now, the owners are also going to want to be concerned about, well, what's my employee cost? Right? If I want to put let's say I want to put $200,000, $400, $500, $600, $700 one of these plans. Said as an owner, probably want to be keeping 85 to 90 cents of every dollar if possible, unless it's an unusual fact pattern. So, but with these types of plans, you also want to make sure your cash flow is a little more steady, because even though you can move your range of contributions up and down, you sometimes can't get to zero. So they let you put a lot more away. You can drive some heavy tax deductions, some great retirement savings, great planning. You can tie up a lot of great people into your company that way. But you also can't turn it to zero. So you want to be somewhat cognizant that, if I'm a year where revenue's down, we don't want it to be completely down. So, they have some different bells and whistles, but they are literally the top of that pyramid. You can run the farthest and the fastest. You can put the most away with those, but you still want to make sure you can live with the rules, right?
Yep. And so if I'm a business owner, I'm thinking that would be great to put away $200,000. You talked about with these employees and how that would have to disseminate out to everybody. Where does it really work well? Is it where you don't have any employees and you're able to run this? Some people do.
That's a big pattern. Yeah, we call solopreneurs. We work with one CPA and she just focuses on solopreneurs. Those are the easiest fact pattern.
No brainer.
Right, because you can say, we had one the other day. He's one person S Corp, right? Takes his W-2, he's got his K-1, he makes a lot of money. And so that's easy to kind of say, okay, you've got a variety of different planning options here. You tell us where this fits the best for you, right? We'll check off the most boxes. When you start getting to 10 employees, 20 employees and up, that's where maybe you use a combination of plans. You use a cash balance or a defined benefit plan with a 401k profit sharing plan. And the reason is that I look at, from growing up in the pension business, 401k profit sharing plans, I love. They're fantastic. And they are the backbone of the retirement plan system for the United States of America. But they're employee plans for the owners of businesses or highly compensated employees that are making significant income in the 6 figures, 7 figures, putting away $60,000. Awesome. $70,000. Great, Andrew. But I need to put away $400 or $500. So it's kind of a drop in the bucket for those that really needed to do significant tax and retirement planning. The other plans are what I call employer plans, defined benefit pension plans, cash balance plans. That's where as an employee, you're going to try to reward yourself. So you are usually trying to control employee costs. So I would say usually the rule of thumb is about 85 to 90 cents of every dollar. If you got 10 employees, 20, 30, however you slice it up, whoever you care about, if you're keeping less, it doesn't mean you don't do the plan, but there's probably reasons besides we just talked about that you're putting it in, right? Could be altruistic. You could be competitive for certain types of talent. Other companies in your industry offer those and you got to be competitive. But other times it's like, look, I don't mind helping my employees, but I want to put the most in my pocket as possible. What can I do to do that?
Yeah, that's where it comes down to that strategic plan design, because like you said, a lot of business owners had a great 5 years, but the next year is going to be the worst year they ever had, right? It's never going to happen.
The business.
And so there is some flexibility too if you create these cash balance plans where if there is a down year in income,
correct,
we're not stuck to doing what we did in the previous year where somebody put away $200,000. There's a formula that then we look at each year with those in business owners and be like, what's income look like? Working with the CPA and then trying to construct that. And if there is a down year for whatever reason, they can minimize that or even freeze it if they had to, correct?
That's right. So they're not inflexible, but you do have to live with certain things in terms of funding elements that you don't with profit sharing 401k plans. But if you said, well, what if I want to kind of advance fund? I want to put more in the first 2, 3, 4 years, and can I tail it off? Can I move you can do a lot of different creative things with these plans. So we're looking at one where we've got a company today. It's for 2 owners, 30 employees. but they're merging into another company. And in 2026, they might have another 100 employees and about 20 to 30 highly compensated people come in. So we have to look at design today. Then we're going to look at design tomorrow. But in the end, there's a lot of different third-party administrators. They all have different strengths. So we work, probably 10 of them. If you could find the right group that can attack that fact pattern, they can usually make it work. So it's actually going to be a pretty viable solution in the end. And and again, will they do it? Maybe it's complex. They're going to bolt it on to their additional, they already have a 401k, but they want to do a lot more planning around it, and it's probably going to work pretty well.
Yeah. So, and to think of the power of being able to put away a couple $100,000 if you've got that type of profit coming in. I mean, you're either paying that to the government or you're paying it to yourself. And then in the manner where people are like, well, I'm building this all up, then what happens? What happens to this cash balance point?
That's exactly right. So people, what sometimes people get hung up on is, how do I get my hands around it after I'm done? And I say, well, I don't understand what you mean. They say, well, let's say I'm going to fund, just like you said, 200, 300, 500, we're going to put away for 10 years. My plan's fully funded. Can't really put in any more after that, because one of the difference between this plan and a 401k prop sharing plan is there's no theoretical cap. You can have as much in those accounts as you can build up. You're capped on what goes into it, but the growth can be exponential. With a defined benefit pension plan, we're defining what goes into it, and then ultimately you have as much as you need to pay out the benefits. So owners go, well, how do I do that? I said, eventually, those assets will end up probably in your IRA account, right? You'll terminate the plan, you'll take your balance just like you would with a 401k, you'll roll it into your IRA rollover account, and then you'll start taking your distributions from there when you need them.
Yeah, man, the goal hopefully too on that end is that your income is dropped because maybe you sold your business or you don't have as much income as you did when you were putting that money in. So being efficient and having that tax arbitrage where if you're getting a 37% deduction on the money that goes in and being smart when that money comes out, or even doing Roth conversions in lower income years.
That's the big one.
Being able to get that money out at a 15 or 20% or even less sometimes, that's the power in it. But that's something where people are like, well, I don't get this. It's a pension plan. No, in theory it is, but it ultimately will roll over to your IRA. Yes, it will be taxable upon withdrawal, but if you're smart on the personal side, and that's again what we do here, is we bring in the business side. We help the business owners do all the things that they need to be doing to be efficient in their business, and that means saving as much on taxes.
Right.
Then the personal side, which is working together in unison, making sure when they don't have that business anymore or their income changes, where's that money coming from, and making sure they're not being stupid or making bad money decisions when it comes to the tax, just because they didn't know.
Right. That's where we see the worst, is that you have inefficiency from a tax standpoint or leakage, right? So what I love is when sometimes these business owners were done funding their plans and then they sell, then we start taking monies that are sitting there that are waiting to be taxed and start trying to convert them and getting them to a tax-free environment at the cheapest possible, which is hopefully less than 22%, right? And so it's a great way. We were able to save all this money in the taxes on the front end. It was able to grow tax deferred. So two great tax advantages, deduction and deferral. And then hopefully we can start converting them out at the lowest, tax cost, right? And even if we didn't, and you still start pulling them in later years and you're going to pay, if you have significant income when you're retired, you're still better off because you had those two wonderful tax advantages compounding your wealth the whole time. And the best thing about pension plans is that if you're a small business owner who's used to taking on risk, as soon as you open your doors in the morning, liability, federal creditor protection. Anything that's in your qualified plans cannot be touched. And such great assets to have.
So we've gone through a lot today. The main component here, if you're a business owner, you want to be as smart as you can be, and just understanding what the options are. And that really sometimes takes time in having the right team.
That's right.
We look at the pyramid itself, the simple and the SEP. Those are basic. Those are easy. Those are ones that can't be house, and that starter house can be built very quickly and can be done even if we're here in November. It can be done. And the nice part with a lot of this type of planning with the SEP is you don't have to fund that before the end of the year. Have to fund it before you do your taxes, so you have all the way into next year. The same can be said with, as we talked on the high level of the pyramid, on the profit sharing and the cash balance. The key component, though, for listeners, what the deadline is for most on the deferral side, if you do have a 401k, you got to get as much into it on the employee side, the deferral side, the contribution side, before December 31st.
Correct.
That's the big caveat.
That's a rule of thumb to have. Yes, I agree.
So if I'm listening to this, I'm like, wow, this is a lot of info, right? But
knock you out by this point,
right? But we know what we're talking about here. How do people find us? How do they, have these discovery conversations of here I am, here's what I've been doing well. how can I optimize it? What are some ways that we've seen people come to us?
Yeah, and again, a lot of our business comes through the accounting or legal community, which is fantastic because I always consider their primary care and we're somewhat of the specialists. But for somebody who doesn't even know the right questions to ask, I say, go back to your CPA and say, look, I know you understand my tax standpoint and our profitability standpoint. What options do you see here for me to be able to execute? If not, can you introduce me to the right people that can help us illuminate those, right? So that's usually where I say, maybe go back to your tax people, go back to your whoever's doing your tax work, start there. Or if you have an attorney you rely on. But others, we have great information that we put out there on all kinds of social media where you good bite-sized topics, or you can get into complex topics. So just do a little research, and I'm sure you can find a group like us or something.
Yeah, or just schedule time to talk with us. 15, 20 minutes, we can at least, may not be able to help everybody, but at least be able to hear where your concerns are,
direction,
and then be able to point you in that right direction. So this has been great. A little bit different than some of our earlier episodes for this year, where we're learning on the journeys of the business owner. It's all about getting that business owner to find purpose in their business and life. But then when we built a successful business, that's where the boots on the ground comes into play, of being able to work with the appropriate team, the coordinated attack with the CPAs, with the estate attorneys, and with the right advisors that understand this world. And that's what we love living in.
Right. And most business owners understand it's not what you make, it's what you keep at the end, right? And so if you can be more efficient about what you're bringing in, you're going to have more at the end to spend.
Because as we talked about in the beginning, on your payroll, one of your most expensive employee
is coming to work one day a week. Where are they?
Equals same.
So, if you got an employee like that, or you got a partner you don't like, you get them out, right?
Well, this has been fantastic. Audience listeners, hope you can see the passion that we have in this. And Brian, I appreciate you taking the time. We're going to be doing a lot more of these as we head into 2026.
I'm excited.
Hope this was valuable. Again, remember to like and follow and subscribe if these videos you found helpful. And we will be back a little bit later the year with our year-end last episode for Your Wealth and Beyond. We appreciate everybody. Happy planning. We'll talk to you real soon. Thanks, Brian.
Everybody. Appreciate it.